Hi, everyone. I'm Rick Bensignor. Today is Tuesday, September 20th, and welcome to this week's In the Know Trader Show. Well, we've got a kind of lousy day in the market. The S&P is down about 40 points as U.S. 10-year interest rates push higher to the highest level they've been on this entire move. They're about 3.59% as we record late morning. Crude oil is off about $1.50. Natural gas is pretty unchanged. The dollar is up 23 pips, pushing it to just about 110, and gold down $4 on the dollar strength at 1674 and holding above the critical level of 1663. Let's take a look at what we have on tap this week. In our trader education portion, we're going to talk about that good decisions don't always have good outcomes. And then when we look into our focus this week on a particular sector, we're going to look at the energy sector. We haven't looked at that specifically since July, so it's a few months now. Lots going on there, both in the price of crude as well as the energy stocks themselves. So we'll take a look at the S&P Energy Index via its ETF, the XLE. We'll look at it, how it's performing versus the S&P, and then we'll take a look at the top 10 names that make up the S&P 500 Energy Index. Let's take a look at just quickly some of the products that I have for you. One is our weekly ETF Tactical Trader Report. Generally comes out on Thursday evenings, gives you a very good broad background and good detail into what's going on across the macro sectors, the macro asset classes, better said. So we're talking about bonds, stocks, the dollar, commodities, credit spreads. You get a full background and everything you need to know to approach the coming week. Then I give you a new ETF trading idea each week that I have good belief in is going to work in our favor, and that could be a long or a short. And then I finish up by reviewing all open positions that we have until they're closed out. So every week you get updated charts. If we need to adjust targets or stops, we do that. So you get basically hand holding from the time that we put the trade on until we close it out. That's the weekly Tactical Trader Report. Ideally for those who like to trade in the short term, I'd say most trades fall into a holding period of several weeks to a few months, but it's not intended to be long-term investing. That's why we call it the Tactical Trader Report. The other report that I publish for individual investors as well as financial advisors and anybody who manages money is the monthly 7-Eleven report. And this report, the whole goal of this report that I started in August of 2020 was to outperform the market by being in no more than 7 of the 11 Spider Macro ETFs. So there are 11 sectors to the market like energy, technology, utilities, consumer staples, consumer discretionary, etc. And combined, those 11 make up the return of the S&P in their proper proportions. What we do each month is try to pick no more than 7 to avoid the likely underperforming sectors with the goal of, therefore, outperforming the S&P. And you've got some stats here in front of you to show you how well we've done with this. In 2022, we have outperformed by 3.43% versus the S&P through August 31st. And again, this month, we are outperforming. Since we started this in, again, August 1st of 2020, we are outperforming the S&P by 8.23%. So we are handily beating the market. We are achieving our goal. And we do so in an easy way for you to follow along and manage your own portfolios, investments. Instead of just using spiders, use our recommendations to have market exposure, but again, in the better sectors to be in. And of course, past history is no indication of future results, but you can see that over time, we have consistently outperformed. We're in the neighborhoods of something like 30 basis points a month on average. We outperform the S&P, and over time, that keeps adding up, and such that we are ahead by over 8% in the 2 years. So this is something that I've priced very reasonably, under $100 a month. And if you subscribe to both products, it gets even less. And if you subscribe on an annual basis, it gets even less instead of going month to month. All this information is on our website, inthenowtrader.com. If you are watching this video, you're probably watching it through my In the Know Trader YouTube channel, but in case you don't subscribe to it, go to youtube.com/inthenowtrader and click on the subscribe button. And this way you will be able to follow all my reports or videos, better said. And of course, follow me on Twitter, and my handle there is @inthenowtrader. So that's the products that we put out for you. Let's take a look at this concept that I spoke about as far as this whole idea that sometimes a good decision doesn't always end up with the outcome that you wanted, but it was still a good decision. And a lot of people have a hard time wrapping their heads around this concept, because we tend to be, as individuals, very focused upon the results of what we do. And it's not actually a great way to judge yourself, because if you did your analysis properly and you make a decision because at the time the decision was a solid decision to make, if it doesn't work out, either short-term, long-term, whatever the case may be, but if it doesn't work out, it doesn't mean it was a bad decision. So don't judge yourself simply on the results of your decisions, but more on the quality of the decision-making you made. So I'll give you an example of something that may be able to help put this in perspective before we actually look at this in terms of an individual, let's say, name to have chosen to invest in. And it's going to be a football analogy. So let's say your team is trailing in the game. It's late in the fourth quarter with a minute to go, and you're on your opponent's 1 yard line. So all you have to do is move the ball 1 yard, and you'll now score and actually go ahead of them with less than a minute to play. And you've got a running back on your team who's one of the top running backs in the NFL. And the obvious thing to do is to have the quarterback snap the ball, turn around, hand the ball to the running back, and let him make the 1 yard gain to score a touchdown and actually go ahead in the game. And let's say that it's now second down and you're on the 1 yard line. And you know that the defensive team is expecting you to run the ball to make the 1 yard. And instead, you make a call to throw into, let's say, the end zone to one of your receivers to make a catch, knowing that the odds of a short pass like that being intercepted is 2% or less based on statistics. So it's very unlikely that your quarterback throws an interception. More likely is that either it's a incomplete pass or your receiver catches it, and therefore you make the decision, let's say as the coach of the team, to surprise the defensive team, and on second down here you throw this short pass, knowing that if it's likely incomplete or caught, the odds are good that either A, you've scored a touchdown and you've gone ahead of the other team with very little time left in the game for them to catch up, or your quarterback throws an incomplete pass because he can't find an open receiver. And statistically, the odds favor that this is not a bad play to call, because if it doesn't work, you have third down to score and even fourth down to score the 1 yard. And certainly with less than a minute to go, if you still haven't gotten in and it's fourth down and the field goal isn't enough for you to go ahead, you have to score the touchdown, you're going to go for it on fourth down. So essentially you have 3 plays to move the ball 1 yard. So you end up you have your quarterback throw the ball. And the outcome ends up being a bad outcome, which is the other team intercepts the ball. You now don't get a chance for third and fourth down. You've actually given the ball to the other team who's going to run out the clock. And that's it, game over. This has actually happened. And this happened a few years ago in the Super Bowl when the Seattle Seahawks were playing the New England Patriots. And Seattle coach Pete Carroll called this now very famous, horrible play, as the press deemed it, to throw a 1 yard pass when you had a great running back who could have just taken the ball and hopefully moved that 1 yard, or certainly had 3 chances to move just 1 yard. So Pete Carroll got the Seattle Seahawks lost the Super Bowl in what was called the worst play calling ever in Super Bowl history. And Pete Carroll, the coach, was eviscerated in the press for calling such a stupid play. And, goes down in the annals of history as a terrible, terrible blunder. But here's the thing. It was not a terrible call. The execution was poor. Russell Wilson throwing the ball that got intercepted from the 1 yard line was very poor, if not terrible, execution. But the decision to go on second down to throw a very short pass into the end zone, surprising the opponents who most likely were looking for the obvious running play, was not a bad decision. It just had bad results. And that is something that the Seahawks have to live with for the rest of their careers, and Pete Carroll has to live with. However, he didn't make a bad decision. The quarterback poorly executed the idea, and that's what cost them the game. So why do I bring this up? Because there are times that you frequently face in the market that you might make a well-educated, well-informed, good decision, but the outcome doesn't come out the way you wanted it to. And you can't beat yourself up that you made a bad decision when you actually made a good decision that just didn't work out for you. Think of it in terms of what are the odds, the likelihood that what you're doing is correct as compared to the odds that it's not correct. So if you line up a trade and you have enough reason to think that where you're buying a particular stock is the right place for the variety of reasons that you've put together, if it doesn't work out, it doesn't mean you put on a bad trade. It doesn't mean you made a bad decision. It just means it didn't work out. So if you had let's say you set the odds at 70% that your trade was going to work, there's still a 30% chance that it wasn't going to. And a 30% chance is not, a 5% chance. It's 30%. There's plenty of times, as in 3 out of 10 times, that you line up this trade that it's still not going to work. And you're never going to have 100% time that something always works no matter what, because once the marketplace knows that it's always going to work, it's going to get gamed out such that it's not always going to work. That's just the way things are. So think about the times that you've done your homework, you've properly lined up and made a good decision to get into something, and it didn't work out. Don't base your results or your decision-making quality on the result as compared to learning to make good decisions. If you make good decisions over time, you will do well in the market. So it's about the quality of your decision-making as compared to the result that you get. Because when it comes down to it, in theory, it's a 50-50 chance that anytime you buy the market, it's going to work or not. If you play with the trend, in theory, it increases more. But at any given time, you could buy a stock that's in a rip-roaring bull market, but you just picked the wrong time to be a buyer, and you end up losing money on the trade. It doesn't mean it was a bad decision. It just means it didn't work out. And I want you to think about that. So let me go to our charts here in our slide. So here's an example of what I think is potentially making a good decision. Whatever this stock is, you happen to notice that each time it sells off, it pulls back and holds the baseline from the cloud model, right? And then it rallies here and pulls back again and holds the baseline on its low and turns around and makes new highs for this move, and then pulls back again and holds, comes to the baseline, turns around, goes back again. So the next time it comes down, it's not a bad decision at all to be a buyer here. In fact, it makes good sense to, based upon history. And if you bought it on the open that week, this particular stock closed on the high up against, some prior highs, but a good decision to be a buyer based upon what's worked in the past. So you've made a good decision and something that you can't argue with. Now, does it mean that the good decision always turns out to be the one that makes you money? And if we go to the next slide, we'll see that that purchase was good for a week or two, and then everything fell apart. And we broke beneath, 2 weeks later, we broke beneath the orange colored line, which is the baseline from the cloud model. And that started to move down to the cloud, which rallied and held against those same lines in the future. What is this? This is actually the QQQ. Would it have been a crazy idea to have bought this, where we have this blue kind of cyan colored circle? No, at the time, it would not have been a bad decision. It did ultimately turn out to be a bad outcome. But that doesn't mean you're a bad trader, that you beat yourself up, because at the time, it was the right decision. And if there's anything I can help teach you along the way, and obviously I do these each week to help you, the investing public, learn from somebody who's been playing this game at a very high level for over 40 years with some of the biggest and most prestigious Wall Street firms in significant executive positions at these firms, as well as having been a commodities pit trader for 12 years before I even got to Wall Street sell-side firms, is that there are times you're going to make decisions that just have bad outcomes, but it doesn't mean it was a bad decision. And what it really means is for you not to beat yourself up over it, because the consistency of making good decisions is what ultimately leads you to making money in the markets. That's this week's Trader Education. Let's take a look at our charts now. So here is XLE. We're focusing on the energy sector. Here's the current picture in real time. And what we've seen is, the top made in June in the energy sector. This is when crude oil got to over $130 a barrel, and the slide since. So XLE is kind of mid-range over the last several months, holding against its downtrend line, holding above its major uptrend line. The likelihood, the way I see things, is that this likely falls down to the top of the cloud, which happens to be over the next month or so, just where the major uptrend line is. That's my thought of where XLE is going. So this is the basic look of being inside the middle of the triangle, but if I had to be a betting man which way this goes, I think it likely heads lower and comes down here. So from the current 76 and a half range, we're talking about getting down towards 70-ish, if not lower. So almost 10%, let's call it 8 to 10% downside here before we again have to play with the uptrend line. So that's your risk. And similar kind of upside to breaking above the downtrend line, but to me, we've got to get Friday closes above 83.09 and a couple of them to really say that we're moving higher. I don't think it's likely happening. So my way that I'm suggesting you think about the energy complex right now is that this likely pulls back. Let's take a look at energy against the S&P so we get a sense of relative performance. And in the big picture, this is going back several years now on a weekly chart, you'll see there's the inverted head and shoulders pattern that broke out basically the beginning of this year, breaks its neckline and zoomed higher. It went all the way up to the peak in, let's see, in relative terms, this peaked out, right? The first week in June. This is where we trimmed. So in that 7-Eleven report that I told you we put out to beat the S&P, last August, we bought energy. It was because we expected it to outperform. And we bought it right here on the setup 9 count down. And we held it through the first week in June, where I trimmed 30% of how much exposure we had on. And then here against this double bottom and TDST line is where I added 10% back in. So we're holding about 8% in energy versus a benchmark of somewhere around 4.5% or so. So we're largely overweight. And I want to kind of just see over the next couple of weeks whether or not this holds or not. I'm thinking that the way oil is pricing itself, it could very well be also starting to price in recession, in which case this could slide back. But I'm kind of holding where things are now. But this is the big picture of what we have, and you'd have to take out the highs and even take this level out here in order to really think that you get a whole nother leg higher. You can also look at this from the lows. For those of you who know Elliott wave, if this was the whole secular bottom in 2020, which I believe it was for energy, then if that's the bottom, you've got wave 1, wave 2, that was wave 3. This most likely finished wave 4. So you're in wave 5. And wave 5 doesn't have to necessarily take out the high here, but in general, you think that there's still a piece of a leg left here to it. That's the way I'm looking at things and why I continue to still have an overweight in energy. Now let's take a look at the individual names that make up the energy sector. So we'll go through the top 10. Let's start with Exxon. This, you can see, looks very similar to the XLE chart itself, the major trend line, multiple touches to it, the fact that it's got a potential top in place, and over the next month or so or more, we certainly think that there's a chance here this can test these lows in here near 80-ish. Look how many lows there are, and that's going to coincide with the trend line on the top of the cloud. So same thing, mid-range here, you don't have much VIG or edge to shorting it here or getting out, but my guess is it's going lower. All right, let's look at CVX, Chevron. Let's put up our trend line and see what this is showing. I suspect it's somewhat similar. Now, it's different because notice where the trend line is relative to the top of the cloud. This is actually technically stronger than Exxon is, and its cloud is higher and closer to price action and farther away from the trend line than Exxon. So this is the better name to be in of the two. And same thing, your mid-range of where you've been over the last several months, from where the high was to where the low was in July, you're kind of mid-range here. But this has support sooner, and those are important levels to kind of look at. The top of the cloud support, and of course the bottom here at 133.80 or so. Okay, let's look at ConocoPhillips, COP. This, I can tell just by looking at it, if we draw our trend lines, you already can tell you're closer towards the upper end here than the lower end. So even looking at that kind of bigger triangle, we're nearer the upper level here. So this is now even technically stronger than Chevron is. So I wasn't looking to rank these, but in looking and doing the analysis, we see that Conoco is better than Chevron and Chevron better than Exxon. Interesting. Okay, move on. Oxy Petroleum, OXY. This just made a new high a few weeks back. So this is even stronger. And I'm just doing these based on cap weight and the XLE, but this is even stronger and even more significantly farther away from its cloud. So this is now, Oxy is actually the best name of the four that we've looked at. But look, if it breaks, you'd look for the top of the cloud and the bottom of the cloud to be next support levels. And you can see that at least the top gets close to lining up into this horizontal support level going forward. EOG. Looking like many of these other ones, 13 on the all-time high, or actually may not be the all-time high. Let me see, is it? Yeah, it looks like it is. Okay, anyway, so similar in the sense that we have a trend line in place that it's still holding above. And you have a minor downtrend line here. And so this is middle and no particular edge to playing this name. Pioneer Resources, PXD, closer to its cloud. Still, all these have downtrends from the highs, downtrend lines from the highs. But we haven't made a lower low yet, so we can't really call this a downtrend yet. It's simply in a, we have a downtrend line, but you'd have to make a lower high, which we had here, but then you'd have to now make a lower low beneath this low here from July in order to say that it's in a downtrend, at least in the near term. Same thing, not much edge to this, and I'm not sure, but this looks like might have broken that uptrend line. Let's see. No, it's staying right to it. So same thing here. Botany of the trend, the major trend line is right where the top of the cloud is. Not a crazy place to do some bidding, at least for short-term play, but understand your risk is, to now test those July lows. So you'd have to be very tactical in nature if you buy there. Schlumberger, SLB. Let's take a look here. If this trend line has broken, kind of had a 1 week beneath it, and it's been hanging there. I don't love the fact that this has a 9 count here. So it's still holding up. I'd be more concerned if we come out through the bottom of the cloud that it's then going to fall at least to the TDST line now, which is probably another 8% lower. So not loving the way this is, especially because of the 9 count. It's the only one we've looked at that has a short term. This didn't have a 13 on top, but it does have a 9 count on the recent rally. So that's somewhat concerning. Marathon Petroleum, MPC, made a 13 right on its highs. Same, look, these all look very similar. So this is just holding above the trend line, but you can see there's room for this to go on the downside. It's already confirmed the 13. So this one I'd be a little more concerned about also compared to some of the other names. Valero. This is one of the weaker ones, just in the sense that it's this week it's already come and kind of tested some of the other lows. Big spike high. Still holding some support, but the door on a breach here, the door gets opened for a move down to 90-ish, if not 83, which is well lower. And then the last one, Phillips 66, PSX. Different looking chart than we've looked at. Trend line looks like it's broken. Let's see. Yeah, we kind of broke it. It is holding the cloud, but this has been much more sideways than the other one. So this is not as strong a name. It's not one of the ones that I'd be more inclined to be in, and it's in deep trouble if it gets under 68 and change, 68 and a half-ish or so. That's still well away from where we are, but I would really pay attention to that going forward. That's it for this week. I hope you got something out of the show. I suspect you did. And I'll be back, let's see, next week is Rosh Hashanah. I will not be doing a show on Tuesday. I might do one later in the week, but I'm not going to do one on Tuesday. Alrighty, thanks for tuning in. I'm Rick Bensignor. This has been In the Know Trader.